I'm an Airbnb founding partner at Candide Group. We are an investment advisor. We work with clients, asset owners who take a full portfolio approach to integrating impact across asset classes and sort of across sectors. And in general, we like our approach is really trying to apply the transform finance principles, a systemic change lens to whichever sector, whichever asset class we're looking at, right? So rather than just assuming that by virtue of investing in clean energy or by virtue of investing in microfinance, we've already sort of checked the box on impact. We kind of go deeper and support best-in-class models. As we like to say, some of you probably have heard me say this before, the how as it is the what, right? It's not just about the what, doing microfinance, but also, how are we doing it, or how are the managers doing it? So this is true for any sector for us. I think it's in some ways like particularly true for microfinance, because microfinance has, is essentially preceded really impact investing or other sectors in impact investing in scaling and reaching scale and reaching prominence. A lot of what I found it really interesting as I was looking back at some articles to notice that just as we're now in 2018, 2019, there's a lot of talk about impact investing going mainstream and what are some of the risks inherent in that. Those same articles were being written about microfinance in 2006 and 2007, right? Interestingly, the biggest huge success story, IPO success story in the microfinance sector, Compartamos in Mexico, was in 2007, which was really the same year that the term impact investing was coined, by the Rockefeller Foundation. So in some ways, the microfinance sector has kind of gone through that wave, and those questions around impact washing, the depth of impact, risks of impact gone wrong, maybe a decade before other sectors in other areas of impact investing. So when you sort of look at for microfinance, the scale's been the scale's been tremendous. The growth was tremendous, even 10 or more or 15 years ago. And at the same time, as organizations were trying to really validate and confirm the impact, or really lifting people out of poverty, alleviating poverty, supporting entrepreneurship, the results were sort of mixed at best, right? Even kind of putting aside some of the more controversial or visible cases where organizations that were engaged in unethical practices, even putting those aside, in my slides, if we had them, there are a couple of interesting quotes of studies that were conducted, a Bank for Reconstruction and Development, the EBRD, trying to gauge the impact of microfinance, and essentially generally coming to the conclusion that that access to microcredit alone has not led to a substantial increase in incomes, have not had the kind of impact that the sector sort of purports to have. So there's been generally pretty scant evidence, at least at a sort of sector level, that microcredit achieves the impacts that it sort of set out to achieve. And with that in mind, I think with all these critiques in mind and with all these question marks around, there's some real predatory, unethical practices on one end of the spectrum. There's maybe a lot that's happening that is maybe not negative or predatory, but also questionable in terms of the ability and success to lift people out of poverty. We, I think our basic observation and question was that oftentimes when we talk to managers and some of as an impact investor, if you're an asset owner looking to deploy a significant part of your asset allocation towards impact, microfinance is pretty much bound to be on that menu. Right? It's going to be offered as there are many managers with significant track records. We were a little bit surprised to notice that when you look at those managers and you ask these questions around impact and how do you avoid some of the worst practices and or how do you try to really support organizations that really are having more success from an impact perspective, the answers were not what we were hoping to find, to be honest, right? And when you look at impact reports for most of the industry, for example, it really kind of tends to boil down to a couple of things, right? You'll see the number of loans, the average size of a loan, the percent of women borrowers, but really not a level of that probably addresses the questions or concerns that we had, quite honestly. I don't know if I'm controlling the slides here, Andrea, but you could you go down next slide. And these are just the quotes from the studies that were not finding the purported impacts in microfinance, and so yeah, this slide is, and then us really trying to apply a more nuanced lens to the sector as we were talking to managers, as we sometimes very non-scientifically call the approach our good, better, best approach, right? It's within the spectrum of interventions and strategies related to financial inclusion or microfinance, how can we really try to lean into and identify and lean into models that are going deeper? And these are some of the questions that we were really trying to hone in on. So obviously kind of looking at lending practices, transparent lending practices, and how are they enforced? Are lenders being careful to avoid over indebtedness in communities? Is the pricing fair and transparent and clear? Are the microfinance institutions, in terms of their profitability, their return on assets, their return on equity, does it feel reasonable, right? Because it's not just looking at a rate that's being to the consumer. It's really in thinking about whether value is being extracted, you sort of have to look at are the lenders, are intermediaries taking sort of an unfair share of the pie, right? Or is this just kind of what's needed for them to run their operations at a slim margin? Looking at collection practices, so on and so forth in terms of lending practices, and thinking about other products and other products that may have that may complement lending and in creating wealth and value. So how are loans being used? Are they being used for productive uses? What other products are being offered, like insurance or savings or micro insurance? And how are organizations even prioritizing what needs to be? Are they identifying, working with communities to identify the critical needs and offering and designing products that meet those needs? And then thinking about governance and ownership. I mean, this is transform finance. This is what, right? Governance and ownership. We can't skip questions around governance and ownership. Who owns the MFI? Are these entities solely profit maximizing? Are they accountable to communities? What type of liquidity event is being envisioned, and how would that affect the mission of the company? And so on and so forth. These are some examples of the kinds of questions we were asking, and we were looking to talk to with managers as we were looking to identify the kind of best in class approaches. And then moving on to the next page. We ended up with 3 organizations that we thought were represented best in class impact approaches, not to suggest that those are the only ones. For there are other organizations doing great work out there, but just highlighting these three that we've supported for our clients. One was Gala Capital, is a fund based out of Spain, where the thoroughness of their impact diligence was extraordinary, and not only kind of front ahead of making an investment, but the ongoing impact monitoring and management, where they basically track impact scores for every investment, and then they actually tie their own carry. Part of their carry as managers of the fund is linked to the impact score. And then a really strong emphasis on issues like governance and ownership, mission-aligned ownership, mission-aligned liquidity events. Second was another organization that we were excited about was Global Partnerships. They also presented in one of these webinars. They're a nonprofit, very strong kind of research arm, a very sort of thesis-driven approach where they're really trying to identify first what are the best-in-class organizations that they should be supporting, and then based on that they go out and kind of find the and kind of build their portfolio. And so, for example, if they believe that based on their research, the critical need is health education or women's health education or financial literacy, they really they go out and try to lend to organizations that have that as a meaningful part of their offering. And then third, which is why we're here today, was MCE. Where and I won't go too deep on this one because there are better people on the call to talk about the model. But one was this innovative guarantee model that we thought was interesting in the way that it crowded in investors that may otherwise not be participating in the sector. So both on the guarantor side and on the lender or investor side. Secondly, really using that guarantee kind of safety net that the organization has to carefully take on more risk or go to markets and or organizations that other investors don't typically work with, smaller borrowers and frontier markets. And then going back to how holistic and nuanced the impact assessment framework was, and really asking some of the questions that I highlighted on sort of the previous slide. So I think I have one more slide. So just quickly as a tee up the conversation around the guarantee model, which to us was really interesting and not immediately intuitive, and I think it is worth really thinking through and understanding. We're more to I think what we often see subordinated capital model when it comes to catalytic capital, right? So that would be, for example, Global Partnerships uses that model. Others like Sun Funders mentioned here, many others, right, where the subordinated capital, that capital is deployed alongside the senior capital as part of the fund, but it just kind of comes in the waterfall, right? It gets paid only after the senior investors get paid. And what's great about that model is that it offers really great leverage, right? So for every dollar that Global Partnerships or others raise in subordinated capital, they could probably raise about $7 in senior capital, right? So it's really about 15% of the fund, I think, is subordinated, and maybe sometimes less than that. So that's kind of great leverage that the subordinated capital is crowding in. The limitations of that model is that the subordinated capital is taking on really kind of outsized risk in that model, and I don't think there's that many organizations of a size and a risk appetite that are able to play that role. So you kind of end up seeing some of the larger foundations play that role, right? A Rockefeller or Kresge, OPIC in some cases. So I think it's a great model, but probably limited in terms of who plays that game. And then the guarantor model, which you'll hear more about, different in that it's not or the MCE model, the MCE version of the guarantee model, I'd say. Different in that capital is not being drawn, it's not being deployed. It's basically a commitment, right? It's sitting on the sidelines as a commitment to cover any losses in the portfolio and kind of make the investors whole. The leverage ratio is very, very different, right? So whereas a global partnerships model, $1 in subordinated capital can $7 in senior capital. In this case, $1 in guarantees only pulls in 50 cents in lending, right? So it's a 2 to 1 instead of a 1 to 7. So much lower leverage from that perspective. But as you'll hear from Catherine and Elena, that enables them to do other to access different kinds of capital, retail capital, and more diverse sources of capital, because really the ask from the catalytic capital providers is a much lighter ask, and so those two things are sort of linked, right? Because you're able to make a softer ask from the guarantors, it also sort of translates to a harsher ask from the lenders, right, who require a stronger coverage ratio. So kind of to juxtapose one versus the other. I mean, I don't think that one or the other is necessarily better. They're different, and they're achieving maybe similar goals in a different way, but with different capital providers, right? So that's maybe just a little bit of framing and how we were approaching the sector in general, and then thinking about this guarantee model.
Excellent. Thank you so much, Anair, and thank you for rolling with it. Very impressive that you could do it without the slides there. With that, I will turn it over to Catherine. Thank you so much, Catherine Covington, for joining us. I look forward to the presentation and to learning more about the model from that Anair set up for us. And I'm afraid I'll have to move the slides for you, Catherine. So
that's fine.
Just give me a nod or something to it.
Okay, great. Can you hear me okay?
Perfect.
Okay, wonderful. Well, hello everyone, and thank you so much, Anair, for the introduction and the context, and for Andrea for having MCE on the call today. I'm really looking forward to sharing more about our model with you. My name is Catherine Covington, and I am a managing director and member of the senior team at MCE Social Capital. My role is Chief Business Officer. I've been at MCE for almost 2 years now. Most recently, I was at RSF Social Finance for about 7 years, and MCE is actually in their loan portfolio, which you'll understand more about that and in terms of our sources of funding. But what drew me to MCE was the innovative model and the ability, like Anair mentioned, for not only big institutions to be involved, but also for individuals to be able to and help move the needle in emerging markets. And I've been in philanthropy now almost 15 years. So I was really excited to see a model like that. And so my hopes for today are to share about our model and to get some really great feedback and questions from this group. And we really enjoy hearing what our model what ideas our model spurs for people, and what challenges it brings up. Our model's not perfect, which you'll see later on in the slides, some of the challenges and successes we've had with it. But like I said, I'm looking forward to diving in and hearing what the group feedback is. And Elena Pons has been on our portfolio team for over 5 years now. And so she's also joining me in case there's some detailed portfolio questions that people look to get into. So thank you, Elena, for being with me today. So I will go on to the next slide, please. Just a little bit of an overview about what we're going to cover today. I'm kind of 101 version about what we do and where we deploy our funds. I want to give much more detail in our model, about our model, and how our funding works. So, questions you have, Andrea is going to help me keep track of those, but please feel free to enter them into the chat at any time. And if there are any questions that Elena and I can't answer, we'll be sure to work with the Transform Finance team to get back to you with answers to those questions. But hopefully we can answer most of them between the two of us. So I will go on to the next slide and just talk briefly about our mission and our vision. So MCE Social Capital, we're a nonprofit, and we were started or founded in 2005, and we made our first loan in 2006. So, and our mission is to unlock capital to empower families living in poverty to build a better future. And our vision is a world in which all people have the opportunity to improve their lives through access to knowledge, resources, and capital. We currently have a team of 15 people, and we are set up to operate as a virtual organization. We do have small offices in San Francisco and Barcelona, and have people scattered in between. So our CEO, Gary Ford's in DC, our CFO, Wendy Terman, is outside of Denver. So that gives you a flavor for where we're based. I'm based in San Francisco, but I'm currently actually outside of Atlanta in my childhood home in my basement. So if you see me put on my headphones in a minute, that's because my upstairs has decided to play the piano. So you can move on to the next slide. So just wanted to go ahead and give you a little bit of a teaser about our model before talking some more about our portfolio and then doing a deep dive. So MCE's business model, at the core of it, top left-hand side, are our philanthropic guarantors. When we started in 2005, we had 7 individuals that were willing to go on a journey with our founder to do something that we had not heard anyone do before, which was pool philanthropic guarantees at the portfolio level using individual commitments. And we had 7 brave individuals that were willing to sign up to test this out. And we also had, contacts at, Calvert Impact First Republic Bank that were willing to hear us out. This model might work. And so the guarantors, the way that it works is our philanthropic guarantors, who now make up a mixture of individuals, primarily still individuals, about 80%, foundations, and then also charitable trust, sign philanthropic guarantee agreements with MCE. They're unfunded, meaning that there's no movement assets required. And those commitments, those signatures, essentially act as collateral for MCE, and we're able to draw capital facilities that we have with lenders like First Republic Bank, the Overseas Private Investment Corporation, Calvert Finance, etc. A group of over 50 individual and foundation investors. Those are the lenders on the right-hand side. That capital comes to MCE, and then we use that capital to deploy in different portfolios. So both microfinance, which we have been doing since the beginning, deploying capital to majority tier 2 and tier 3, so smaller microfinance institutions and emerging markets. Second newer portfolio, which was launched in 2017, direct lending to small businesses. One more note before we move on from this slide, and like I said, I promise to go into more detail into this later, is that we started out with 7, now we have over 100. So that model has been, it worked, and we now have a great track record, and so we'll talk more about that a little bit later. So this gives you a kind of an overview of the flow and how things work. Go on to the next slide. Just wanted to give an idea of where we work. So we are 5 countries. You can see the countries in red are our active portfolio companies as of the end of 2018. Red is microfinance, is small and growing business, and purple is where we have both portfolios active. So we're in Latin America, Africa, Eastern Europe, and Asia. And that diversity is very intentional from a risk mitigation perspective. But keep our portfolio team very busy, which Elena can speak to more a little bit later. So just wanted to give you a flavor of our geographic diversity. And then slide, this is our portfolio growth. So since inception, we have deployed almost $200 million in loans, and I'll talk more about our track record in a moment, but just wanted to show you portfolio has grown over time, starting in the very beginning with only 7 active countries and a very small loan balance up to over 60 million at the end of 2018. So steady growth, which has also mirrored our steady growth in guarantor and our guarantor base, because we can't deploy more capital than we have guarantee support for. So the chart on the guarantee recruitment side has looked similar. We can move on to the next slide. So just a little bit more information about our microfinance portfolio. You can see some stats here. I won't read them out loud, but you can see what some of the sectors our microfinance institutions involved in, geographic diversification. You'll see here too this gets to some of our risk mitigants. You'll see we've highlighted here the largest country and the largest borrower. On the portfolio side, we have policies in place that board approved, that we more than 15% of our portfolio into any country and no more than 10.1 institutions. So that's very intentional from a mitigation perspective. And one thing too I wanted to share is that we often compare to some of the larger microfinance funders. And one thing, and they are touched on this briefly, but because of our mission focus and because of our philanthropic guarantee base, we do feel like we can be much more intentional about taking risk. We have one of our larger institutions that we're close with sees us often as their snowplow, meaning that we go earlier and invest in some of the smaller microfinance institutions first, and with the hope that we would love for them to continue working with us as long as they can, but sometimes the organizations do get too big and they graduate to one of those larger firms. But we like being known as the snowplow. That is what our intent is, to be able to take measured risk and be thoughtful about improving our mission. So you can move on to the second slide, the next one. So just one example, and you can take more time to read this later if you're interested, but this is Fundacion Espoir, and it's a partner that we've worked with in Ecuador since 2006. So there's a great story here of we've made 6 loans to Espoir and have seen them through some very challenging times, including the earthquake. It's a really great social mission. We focus on, we prioritize working with microfinance organizations that not only provide credit to their borrowers, but provide additional services. As Anera mentioned, there's been a number of studies that have come out kind of with mixed reviews of microfinance, but also many that are positive. But our take is that, microfinance alone is not the silver bullet for ending global poverty, but microfinance along with other services and support can be really helpful to families. Also, too, it's not just income, and how much income a family's earning, but what type of job it is that a woman, for example, has access to, because working outside the home versus being able to work inside the home can make a meaningful difference to her family. You also prioritize working with microfinance institutions that have a more rural base, so majority and also majority women and beneficiaries. So just wanted to mention that as well. But moving on to the next slide, I wanted to talk a little bit about our small and growing business portfolio. So history here, which is interesting. We started finance since the beginning. Starting in 2013, we started making loans out of our own retained earnings in the area of direct lending to small and growing businesses. We wanted to test it as a pilot because we saw a real need, as I'm sure many of you on the call are familiar with or have heard of providing debt in smaller ticket sizes. We focus on 100,000 to 500,000, a catalytic debt to small enterprises that are too large for microfinance, but perhaps too small, or many times too small for larger financial institutions. And we did that as a pilot for many years. And then in 2017, with support, with a $1 million grant from USAID, we were able to launch a second unique pool and a second portfolio focused on direct lending to small businesses. So fast forward to today, or at least for this slide, the end of 2018, we have 3.7 million outstanding across 15 different small businesses. Our primary gained some expertise in is agriculture value. We have a lot of cashew nuts and shea nuts and moringa trees and fruits in our portfolio, and have really been able to fill a niche there. We just have not come across that many other lenders that are providing debt at the size and terms that we're able to provide. So just wanted to highlight that. And there is a second, there is a separate guarantee pool. There's over 100 guarantors in our microfinance portfolio, 23 in our small and growing business portfolio. So you can move on to the next slide. Again, just an example, you can read more, but this is Talero Global, which is in a rural area in northern. They employ 400 people with formal salary jobs in areas where formal sector jobs are very, very hard to come by, and source from more than 7,000 smallholder farmers in the region. So we're really proud to support this organization, and have given, last year we paid off their first loan successfully, and then we made 2 additional loans to them in 2018. So moving on, just because I know this group is very savvy when it comes to a slide I would always include, but wanted to make sure that you all had it here in front of you, and feel free to ask more questions of us later. But here's some information about investment criteria and what as we do desk due diligence. Of course, we do desk and on-site due diligence with all of our potential borrowers, and so this is shows you what some of the financial criteria is that we are looking for. And in terms of social criteria, that's also very important to us. Looking at management practices, how many women and how many people in rural areas are served, a number, looking at procedures they have in place, and on and on and on. So I could also speak more to that later, but this is on the investment side.
And if you don't mind, Catherine, for those who have joined us on the phone and don't see the slide, if you want to run through some of the criteria, that'd be helpful. Great.
Thank you. Thanks for reminding me about people on the phone. So on the microfinance portfolio, we are making loans to microfinance institutions that have at least 5,000 borrowers, or a minimum loan portfolio size of $1 million. Then we have a capital adequacy ratio of greater than 12%, or debt to equity of less than 5x. We look closely at the portfolio at risk, greater than 30 days plus rescheduled loans. We like to see that less than 10% of the portfolio, and the write-off being less than 2%. Yearly audited financials is very requirement. On the microfinance side, our size, we don't do this often, but we can go as low as 100,000 and up to 3 million. Our average loan size on the microfinance portfolio is about 700,000. The pricing ranges between 6 and 9% in USD, and our average is about 7.25%. Tenor, or the term, is 2 to 5 years, and the capital is either senior or subordinated debt. The small and growing business portfolio, we look for for-profit entities with at least 3 years of operations, with positive debt to equity and debt service coverage ratios. We look for sustainable and scalable sources of revenue, greater than $200,000 USD per year, audited financials for at least 1 year, the ability to provide financial statements, and fewer than 250 employees. The investment structure is between 100 and 500,000. One note here is that we can go larger if we're able to apply. We have available to us a blanket from USAID that can help the risk of making larger loans. Talk more about that if people are interested, but without that, we try to stay under 500,000, but we can go larger in certain instances if the loan fits under the USAID criteria. Our pricing is 10% interest in USD with an average of 8.5%. Our term is 10 months to 4 years. We do some project financing here. And so just wanted to mention that. And also capital is either senior or subordinated debt. And we often get questions about hedging. We lend in USD local currency, and when in local currency we hedge through a partner, MFX. Move on to the next slide. So a little bit more about our impact as of the end of 2018. These are some of the metrics that we track, not all of them. We had 64% female, 57% rural. Like I mentioned earlier, we prioritize working with organizations that offer additional financial services, additional non-financial services like savings products, remittance services, mobile banking, insurance products, technical assistance, business education, energy efficiency services, and social services. So you can see at the end of last year, 56% or more of our portfolio offered additional financial services, and 44% offered additional non-financial services. And it varies a lot by region. We look at what the baseline is for that region or country, and you look to see where how our borrower performs against that benchmark. And on the small and growing business side, we're looking jobs supported, smallholder farmers engaged, people with improved water access, and also people with clean energy access. Move on to the next slide and about our track record, and then we can get into what our balance sheet looks like more. So we're really proud of the fact that since inception, we have maintained 100% principal repayment with interest to our lenders and investors. We have invested, like I mentioned, almost, well now, as of 200 million in over 115 institutions across 45 countries. We've had 112 million in loans mature, and we have 2% default rate. You'll see here, this is kind of the beginning of diving into our model a little bit deeper, but for every so we've had our guarantors have committed $100 has gone out, and this is just a numerical example, for $100 that have gone out in loans, for example, we've 98 repaid, and $2 have come in from our guarantors to cover those losses. But I'll walk through a more detailed example in a moment. So moving on to the next slide, this is what our balance sheet looks like. So if you focus on the middle column, you'll see, we have an outstanding portfolio as of the end of 2018 of 61.6 million. We have other assets, some of our own cash and reserves of 7.5 million, and then we have liabilities, which of 63.4 million, which you'll see the purple line going off to our left, that represents commitments from our lenders. And you'll see here kind of the breakdown of our sources of funding. We have over 20 million outstanding in investment notes from foundation investors primarily. We have commercial banks involved with us at over 20 million. We have development finance institutions like the Overseas Private Investment Corporation and Proparco, which is in France, was 17.4 million, and then we have some other foundations or organizations like Calvert Capital and RSF Social Finance, 4.7 million drawn down on those facilities. And what's interesting is that off of our balance sheet, because they're unfunded commitments, is the $136 million in off-balance sheet guarantees. And go ahead and touch on this a little bit now. I mentioned earlier in the beginning when we started, we had 7 individuals, and we had a model that was untested, or one that people hadn't. And so when we were initially, or hadn't seen work, we were initially approaching our lenders. They were like, okay, you're gonna have individuals, back this. And so they were really wary of us utilizing those guarantees 100%. But just a little bit of history, we had to start at a ratio. I think maybe we actually started with a 60% utilization, 50%, to give our lenders confidence. Those individuals' portfolios sizes might ebb and flow. All accredited investors, they were just concerned about, particularly since we weren't taking on any, that they wanted to be extra sure that if there was a default in our portfolio, that guarantors could cover. And if a guarantor defaulted, like couldn't pay MCE, the way that it works is that the other guarantors can technically go they can go after that. So that's another. It gives the lenders a lot of comfort that there's that 50 buffer that to make sure that our individual guarantors especially make good on their commitments. So I can talk more about that later and answer questions, and this also shows up later in kind of the pros and cons. There's some ways in that works well, and some ways that's very challenging for us. So feel free, also just want to remind anyone that has any questions, please feel free to enter them. But I inserted this here just because I think the ways to get engaged, this is not a big push or solicitation, but just because it's relevant to our model and why and how it helps with our sustainability and our operations. So the 2 ways that we engage with individuals and foundations, and this is where I focus almost all of my time, is working with philanthropic guarantors. So you can either become a philanthropic guarantor, which that's the core engine of our model. The more guarantors we recruit, the more that we can deploy. It's currently our biggest bottleneck. We don't have any problem with pipeline in terms of places to deploy capital. We have greater sources of financing than we can draw. The number of guarantors that we have is our greatest constraint. And also the global economic opportunity notes is our investment option. And this is super helpful to us, particularly interest rates have risen and then they stabilized. And we, with our bank financing and our development finance institution financing, those interest rates are often based on a basis point amount over treasury. And so those fluctuate. And can be, our average on the bank financing side is closer to 5%, but our notes offered at terms between 2.25% and 5%. Our guarantors get a little bit of an increase there, and the more we're able to diversify, sources of notes, the better it helps blend down our cost of capital and really helps our bottom line. We cover the majority of our operating cost from our net interest margin. So the notes have been a really important and tool for us, and one that we've gotten great feedback on from investors seeking impact with very, very low risk. So just wanted to highlight those 2 because they feed into our. So just going on to the next slide, just wanted to highlight that people often do both as well. I think it's okay that I mentioned that the investor that Anair works with decided to do both. They did a $2 million investment and a 2-unit finance guarantee. And the great thing about that is often, based on our track record, we tell people that you can reasonably expect that the from your investment note, depending on the size, of course, but at the $2 million level can likely cover, any expected guarantor calls. And so we have had a lot of guarantors that have also invested in MCE. It's been exciting for us. So, and then also on the, but for both individuals and foundations, this has been appealing. People can also give proactively to MCE in advance if they want, even out any kind of surprises with the predictability of. Can move on to the next slide. Great, and so this is, I'll just summarize this quickly for people on the phone. So just some more about the terms of our investment notes. The minimum investment is $100,000. The financial return, we have 5 and 7 year options between 2.25% and 3.5%. It goes up to 3.5% because if you're a guarantor, you get a 25 basis point increase. And the low risk nature of our notes is because the notes are sitting on top of our guarantee structure, which of course has the 2-to-1 coverage. And there's the impact, there's a focus on financial inclusion, focus on small business, also extreme geographic diversification. And then moving on to, I think probably a lot of people are curious about the terms of our guarantee. We're very open source about this. So I wanted to point out that later in this, I think one of the last slides is a list of and links to resources. So we are, you can see our full-blown philanthropic guarantee agreement. I wanted to encourage you to check that out. I also go into some more detail with this slide and the next one about terms. And so, like I mentioned, our model is powered by philanthropic guarantees. And so here's some of the details of what guarantor is signing up for. The microfinance guarantee, and this is the program where we have over 100, we have 129 across over 100 guarantors. We have several guarantors that have more than one unit. The unit size, and I see some people have looked at or asked about our strategy for recruiting philanthropic guarantors and what have you learned. One of the challenges is that the $1 million unit size is a big sticker shock for people. But what where I talk people off the ledge is that we draw down 500. It's unfunded, so you keep control of your assets. We draw down 500,000 against your signature. You're joining other individuals and foundations that are sharing any potential loss pro rata. Your signature, when I get a signature in the door, we can borrow and disperse $500,000 almost immediately, because of our pipeline and demand for capital in the field. Portfolio losses are shared pro rata among guarantors. We've had 5 guarantor calls on the microfinance side since inception. So the average call per unit for the 5 years ending in 2018 is 6,800. We encourage people to plan for a $10,000 a year profit. And we may or may not need that money. And if you want to go proactively and build up a credit, we encourage people to do so. And what I found is that individuals, it takes a lot of education in terms of model and getting people to grasp it. When people get excited about the fact of utilizing their balance sheet, particularly if they're already philanthropically minded or an impact investor, they aha moment where they're like, wow, I can do everything that I'm doing and help an organization like additional capital in emerging markets. The main difference between the microfinance portfolio for guarantors and the small and growing business portfolio is unit size. So the unit size on the small and growing business side is 500,000. That's because we make smaller loans. We wanted to lower the guarantee unit size. And our first call on that was this year in 2019 for $7,800 a unit. And one other feature of that portfolio is that we do have $1 million loan loss reserve intact. That was important to us to establish since it was a new portfolio and we didn't have a long track record. And so that is a second dollar loan loss reserve that kicks in if a call were to exceed $10,000 per unit in any given calendar year. So I wanted to mention that. Go on to the next slide. Just have a few more slides and really looking forward to diving into questions. This is just some more detail. I pulled out some of the key terms of our philanthropic guarantee agreement for those of you that are curious, and some more details. So all of our guarantors are, of course, accredited individuals and entities. I've talked about the unit size is $1 million for microfinance, $500,000 for small and growing business, and our leverage limit that your microfinance unit allows us to access $500,000, and small and growing business $250,000. So collateral, upfront contribution, or asset segregation required. We do not pay a fee to our guarantors, particularly because you retain control of your assets. Guarantee is at work. A call event is triggered when a loan to an institution in one of the portfolios is declared in default. Very transparent about where organizations stand in terms of we have a watch list, an impairment list, and a default list, and we have 3 times a year webinars with our guarantor where we review those lists every call. We also send out a slide deck with all of that information. Share of the call is pro rata, divided by the number of responsible guarantee units. If you were to sign up today, for example, you wouldn't be responsible for any loans that were on the impairment list if they were to move on into default stage. So you don't join with any baggage per se. It would just be any loans that were to become impaired and then defaulted after you signed up. And the majority of our guarantors do take advantage of the fact that we are a 501c3, tax exempt, and choose to make charitable contributions to us. And termination. So the commitment when you sign up is evergreen until you let us know that you need to withdraw. We have had guarantors over the years that have needed to withdraw as their life circumstances change or some of their philanthropic priorities shift. We do require 18 months of written notice. That gives us time to that unit without having to reduce the size of the portfolio. Go on to the next slide. Just wanted to walk through an example, and many of you may understand this mechanic by now, but this is just on the microfinance side. With $1 million guarantee, you can make a $500,000 loan to an MFI. Multiple loans, then micro borrowers. When that loan is back to MCE, we're able to repay our lend. Only when there is a default do we go to our guarantors and ask for any coverage. So moving on to the next one, this is the default example. So this is when an example where there's a reason for default. And I was just looking back at all of our historical defaults, and they've really ranged, in terms and reasons. As best we do an extremely, and Anair can speak to this, and maybe others on the call. I think a little bit later I'm going to ask Songbei from Calvert to chime in, but our due diligence process is extremely rigorous. But as everyone knows, there's always things that come up you can't anticipate, like fraud, for example. So we've had some instances of fraud. We've had extreme challenges in Azerbaijan, for example, which was a real darling of the investment community many years ago. But with the commodity crisis and various things happening, we have some defaults in that region. And so just when that happens and there's a failure to repay, one note. Quickly though, we have recovered on average 50% or greater on our loans that have been labeled in default, and so we have never had like 100% loss. So, but when we're confident that we are going to be able to collect and have a really good idea of the final number, that's when we, go back to our guarantor community and ask for gifts to cover any loss so that we can always repay our lenders. So almost done here. So this is one of my favorite slides, just as a business development and potential guarantors, is the power of the guarantee. I mean, despite 2-to-1 leverage, which most of our guarantors don't even feel, we feel it as MCE because we would like to utilize the guarantees 100%, but talk more about that in a minute. I like to talk this one for people that are on the phone. This slide shows, depending on when you joined as a guarantor, how much in lending your signature has enabled. But I'll read out one example, one quote for those on the phone. So a microfinance guarantor who joined in 2006, their signature has personally enabled 2.5 million in disbursements to MFIs across the developing world. That's because your signature unlocks 500,000 and we lend it, and it's back 3 years later and we re-lend it, so it's recycled. And during that same we have had I can update this now through 2019, since we have had 5 guarantor calls totaling $45,000. So that's a $2.5 million disbursements that have been mobilized versus $45,000 in charitable contributions that individual has made since 2006. And just one quote I'll share. Bonnie Meyer has been a longtime supporter of us, supporting microfinance for years, individually, just making grants to organizations. And then when she said, I understood that by using my asset in the form of a guarantee, getting less, average around $5,000 a year, and compounding the effect by over 25 times, I signed up immediately. And I can just say that people signing up immediately doesn't happen super often, but Bonnie was one of those. And she had an aha moment. It was like, why wouldn't I do this? So we really appreciate her support. And then the final slide before we to questions is I just wanted to talk about, and too was really helpful to see, some of the other models that you brought up, and I'll also share on this slide some of the other models that we're aware of, but some of the pros and cons to our existing models. So some of the pros, is our track record of $200 million deployed, impacting millions of emerging markets, 2% default rate, multiplier effect of dollars deployed, defaulted, over 100 individuals and entities involved in a like-minded community. We have many guarantors that prefer to set it and forget it if they don't have time to engage. They're excited about the fact that their assets are being leveraged. So people call it impact while you sleep. The challenges and cons. So the 2-to-1 ratio, it's a blessing, I think, for our guarantors and our lenders. I mean, we do. Well, I'll get more to that in a second, but it's also a curse. I mean, particularly now with our track record and the strong demand for our capital in the field, we would love to use 100% of those guarantees, and we do get the question often, like, why don't you just dial up that leverage? Well, we've had many guarantors involved since the beginning, or a long time. To manage expectations, if we were to dial that leverage up, well, first we'd have to get everyone's permission to do so, and everyone have to re-sign all of their agreements. But it would all of a sudden, from being expected to pay conservatively pay $10,000 a year in charitable gifts to $20,000, and it would be really risky, to say the least, for us to do at this point. And we also would have some of our more conservative sources of capital. They wouldn't agree to that. We know that. So we have explored, particularly as we have attracted tours with some much larger balance sheets that are not individuals that have. We have explored setting up another structure that would allow us to increase our leverage, and we are also exploring adding other tools to our toolkit. There's nothing definitive, but we are also considering launching a fund that would complement our guarantee structure. So just wanted to mention that. I talked a little bit about the $1 million sticker shock. when I have to get from there quickly to like what people expect to contribute in the form of a charitable contribution in any given year. So that's a challenge in terms of recruitment. The pace of recruitment can be really slow sometimes because our model is unique and not a lot of people have heard of it. There's a lot of education of individuals and the people that they work with, their financial advisors, family office lawyers, and whatnot. So happy to talk more about that if people are interested. Guarantor calls being perceived as negative and overshadowing all of the positives of our work. When we do, we can be cruising along, like particularly the first few years of our history. Our portfolio was a lot smaller. There was not a call in the couple years of our history, and then we had a call, and people were like, wait a minute, they were like not hearing from us very much on that front, and so managing expectations and also always trying to remind people of all the positive that they've made possible, as they're writing the check to cover a loss. Also, a challenge, of course, is complexity of lending in emerging markets. And I mentioned the other approaches and tweaks we've considered in terms of a potential fund structure complement. We've considered also doing an annual membership fee as opposed to calls. But I will pause there. I'm really excited to hear what people in the audience think, what their reactions are to the model, what their questions are. Thank you so much.
Fantastic. Thank you so much. And yeah, let's take some questions. I'll remind you, for those that joined us from the WebEx app, you can put questions in the chat and send them to everyone or just individually to me or to Catherine. And then Anair, based on connection, is joining us from overseas today, might also have thoughts to add on why they combine the guarantee with the lending. One question that came in to me, which I think fits well with our kind of transform finance obsession of that meta impact in terms of actually putting effort and money into the actual innovation around structures. Is this that has been replicated, or do you see willingness for it to be replicated outside of MCE?
Yes, that's a great question, and I meant to touch on that a little bit. Okay. So when we were starting MCE, I'll talk about one model that was already in existence, and then a couple that have come after us that we've been in conversation with and helped inform in some ways. So Shared Interest is another organization that utilizes loan guarantees to lend in emerging markets. They're exclusively in Africa. The difference, and we talked with them about the pros and cons of their model, is that their guarantees are funded. So they take guarantees from individuals, place them in an account in the US, issue lines of credit, local institutions and country to then on lend. And so they're still pooling, but they're funded guarantees. That was a little, that's a difference there, but wanted to mention Shared Interest. And then a group called Talero Global has adopted parts of our model. So would encourage people to check that out. So we were in conversation with them before they started. And so you'll see some of the same terms on their website, but similarly, they have a little bit more complicated of a process. It's a little bit more involved for the guarantor, but they also work with extending lines of credit, encouraging local banks to do the lending. So you can check out the FAQs on their website and how it works. And then one that I'm really excited about, because it is, we as MCE, we have a small marketing budget, and but Cresby, which has been a very active proponent of loan guarantees for a long time and trying to encourage more participation, they have developed a guarantee bank. They call it the Community Guarantee Facility, and there are several other organizations that are involved now. Gary Community Investments and Dignity Health, to name a couple, and they've pulled guarantees. It's being managed by Locus, which is a profit in Virginia, and they are pooling guarantees, and people can, Locus is managing it, but intermediaries and other community organizations can apply for the guarantees as a credit enhancement. And we talked with them as they were wrestling with that idea and trying to get it off the ground about things that have worked well about our model and what some of the challenges were, to point out those 3 examples.
Wonderful, thank you. One question, and then you'll probably see the ones, Catherine, that are in the chat, so feel free to post those as you'd like. On the 5% interest for the lenders based on this long track record with a 2% guarantee, and one could think again as this practice gets established, right, for either for the lenders to reduce the rate at which they lend, or for them to reduce the guarantee requirement after some point of performance. Do you feel like that 5% is in the sweet spot, or is it kind of like a magical number?
Yeah, it really depends on the lender. We, have some very conservative lenders that are not open to change. So, we the guarantee requirement is still important. But we have others that, have love to get higher leverage, and so that's, I think with the track record now and our, particularly with our track record, and also attracting some investors that don't perhaps need the guarantee at all. That's why we're opening up adding other tools to our toolkit to raise capital that doesn't need that type of coverage, while still using our guarantee model to add capital that would not otherwise be in emerging markets. So we think that there's room. Our existing model has worked really well. It has unlocked some capital that would not have otherwise been unlocked. But we're contemplating, as part of our strategic plan, looking ahead, we can add to our toolkit.
Hey, Catherine, would this be a good time? Maybe this is Songbei from Covington Capital. Maybe I can just make a comment on our long relationship with MCE and also address that last question from Andrea. Yeah, well,
thank you for joining us, Songbei. Good to see you.
Sure. Yeah, this is great. We know MCE. We've known them for a long time. We really love their work, so it's always great hearing about it. So just quick background: we made our first loan to MCE as one of that first group when they started in 2005. And we still have a loan. Last time we increased it was to $4 million in 2016, and with some amortization payments, we have about $2 million outstanding. And just to put that in context, we have at Calvert Impact Capital a $400 million portfolio globally across 9 sectors. $1 million of that is in microfinance with 15 borrowers. So we have a lot of experience, and that's where I'm using that experience when I really say MCE stands out, not just because of the guarantor model, but because of the type of lending that they can do based on that. Specifically, it's already been commented, they reach these tier 2, tier 3 MFIs that most of our other microfinance borrowers cannot. The second thing, and which is really key for us, and Catherine's talked about it, but it was key for us, is the SGB, the small and growing businesses. This is something that we've been looking at how to channel our capital and really have not been able to find dedicated SGB funds. But MCE has done a really thoughtful approach. We value our relationship with MCE to learn ourselves about the space. And that just the last point I want to bring up is that I'm an advisor. Well, I call it, I'm an observer on their loan committee. And I think I've heard other people call it advisor, but really we made the loan and we learned so much from the loan committee, especially when they discussed the SGB business and really understand how deep and their underwriting is. And this is also where you really see, I think we haven't been talking as much about the guarantor benefit to the organization. All the loan committee members are guarantors. So the people who put those guarantees up, their money's on the line, they're the ones that are making the decision every time whether to make the loan. Not only are they very aligned, but the guarantors that are involved are incredible experience. And it's really amazing. A lot of them are investors themselves. And so it's been a really valuable learning experience. And lastly about that is they really bring an incredible amount, of commitment to the mission for MCE and what they want to do with their money. Kind of going back is just the last question: how do we view the guarantee? The 2-to-1 guarantee. So the first thing is it's unique. It's unique in a positive way, curse and a benefit and a blessing. The blessing is unique and it allows them to do all this work. The challenge is, even when I present to investment, people would rather not see that. It's just something you have to explain, and in an investment committee, if it's the first time someone's seen it, they just get confused. A lot of explaining to do. I think once people understand it, they really see the value, but it does take a lot of learning. The second, it's individuals. So if it was 2-to-1 for a high net worth guarantor, from a lender's perspective, if it was USAID, it would be 1-to-1, for example. So you're automatically cutting it down in half. And third, if it was cash on the balance sheet, which is how we would probably look at a lot of other lenders as net assets on their balance sheet, then it would only be 20%. And this kind of goes back to the subordinated capital. So if it was equity on the balance sheet, so there's that whole range, and happy to clarify or answer any specific questions about that.
Thank you, Songbird.
Thank you.
Super helpful as always. And if I can jump in for a second, Catherine, with a question for you, perhaps, as well as Songbird, before he pops. Isn't this other obsession of transfer finance, the governance side, and on the inclusion of different stakeholders? I like the idea of the sort of the advisory role or the sort of investment committee role for folks that have made a guarantee, or look at it the other way around. Have you looked at the inclusion of your borrowers as well in some governance form? We're trying to wrap our head around and document some of these, more inclusive, perhaps, governance processes. And I don't know if it could be done at that investment committee level or at the advisory level, but perhaps Catherine knows something about it.
Yeah, no, that's a great question. And to date, while we have on our loan committee, we have all the voting members are guaranteed. We have a number of advisors that sit in that have various expertise and sometimes in country expertise, but we have not we have not involved at that level, like at that level of due diligence, once the due diligence process has wrapped up and got and did the borrowers. But I wonder if maybe Elena, maybe you can speak to a little bit about maybe particularly on the SGB side, how the voice of the entrepreneur and how important it is to get to know the leadership of the organization when we're doing due diligence, if that would be helpful. But it's a great question, Andrea, and definitely one that is important.
Yeah, thanks, Catherine. Great question. We, as Catherine said, we have not involved our borrowers in any of the official committees or boards of MCE at this moment. But what we do have, which happens very often, is that especially on the SGB portfolio, is that more often than not, the deals that are presented at the loan committee sometimes have already received investment separately by one of our guarantors or several guarantors that are on the call, and so we have an opportunity then to have a very dynamic conversation about the deal and about the entrepreneurs itself, because we go through the due diligence and we talk to everybody. We go on site, we talk to everybody of the team, and we talk to the entrepreneurs. But we only have so much time. We only have 4 days, and then we have to make sure we have enough information to do the risk analysis. These investors some of them are guarantors, and some of them sit at the loan committee, are actually sometimes I spend more time with the borrower itself, with the entrepreneur, and sometimes they're almost friends with with this particular entrepreneur, and they bring a lot of a different point of view. They bring a lot of information, and they always provide a lot of value to this conversation. So although the borrowers don't sit at the table, they and a lot of times at the SGB side, they have a voice that we can hear through the other guarantors. I think that's very neat, and it happens a lot. It happens very often with a lot of the presentations that we do. But I know this doesn't substitute having them at the table, and but I think it's very important that the community is very close, and it's really watching out for the best, for the well-being of all the stakeholders.
Great, thank you.
So I was just going to jump in and mention, reference something you mentioned, Catherine, the ability to kind of do both, right, and come in as both a guarantor and an investor and a lender. And I'll say that's something that, as Catherine mentioned, we did or we recommended to the Libra Foundation, and that's and they became a guarantor and an investor. And the reason it was sort of appealing was looking at there's a universe of great high impact opportunities in that kind of 2 to 3% return range. We mentioned a couple of them today. Global partnerships is another one, right? And where this sort of these notes would fall as well. And so the way we just sort of looked at it is, even though these are two distinct decisions and two distinct agreements, and it's not one investment technically it's not one investment that is both a guarantee and a loan. It's two separate ones, but we sort of viewed them as one thing in our sort of asset allocation, and just looking at an investment that would earn say close to 3% interest, and then we just factored in the expected capital calls from the guarantee, and just looked at it as you could just think of it as a 3% loan with using round numbers, call it a 1% capital call as the guarantor, so it's effectively a 2% net interest loan, right? Which is not out of line with other organizations we've supported, like our Root Capital or like a Global Partnerships, but where we are getting this sort of extra bang for our buck, in that we are also crowding in other, or enabling the guarantee dollars are leveraged, and then allow MCE to bring in other lenders in addition. So that's kind of how we thought about the two combined, and we thought that was an attractive or a pretty unique way to do it. And then the other just quick comment relative, which relates to what Songbei was saying. I think it's really interesting. I mean, as a lender, it's hard to there is sort of an established almost standard when it comes to net assets or subordinated capital, and Songbei mentioned maybe 20% tends to be around the standard. Maybe it's 15%, maybe 20%, and so that's kind of where the sort of gravitated towards. This one, we don't have as many. There's not as many points, right? It's fairly unique, and so I would argue that the 200% is sort of, maybe it's a bit of an arbitrary starting point for that. I mean, we don't know what it. I think lenders, I would argue, don't know. Should it be 20? Should it be 50? Should it be 100? Should it be 200? Right? We started at 200. It's not written in stone. I mean, arguably over time, if you there's more of a track record both on the lending side and on the capital call side, right? Capital calls from guarantees, and you sort of have a better sense of whether you should discount the value of those guarantees. Then arguably that number could be a moving target over time. At the same time, there's pros and cons to changing that, right? As if MCE went back and told were to go back to all its guarantors and say, you know what, now it's not a 2-to-1, it's a 1-to-1. You know, I'm not sure if that would always be maybe even be positive for all of them. Some of them might be really happy and say, "Oh, great! Now my dollars are being leveraged to a greater extent." And some of them might say, "Well, gosh, that means my donation next year is expected to be double what it was last year, and I'm not sure I'm ready for that." You know, so that's something to keep in mind as well.
Great, thank you, Anair. I know we're running short on time, but I just wanted to see if I could address a couple more of the questions here that can be perhaps quick. And someone asked about whether you can, you know, fence or target, like if you were to invest, if you that investment you have, and it is all technically, you know, when you're investing in our notes offering, you're investing in all of MCE's work technically, but we do have investors that choose to target either microfinance or small and growing business, or if there's a particular, you know, area. And so we, you know, do our best to, you know, match that capital on the back end and share stories about the impact of that investment. So it was just a conversation. And so we can, you know, definitely work with investors' interest to do our best to like target those funds, but it's just a target and it's not a, you know, legally binding fence, for example. And then I'm also happy to talk with anyone. There was a question about what strategy to use to recruit philanthropic guarantors. There are many different strategies, but the most effective one that we have found is activating our current and having them invite other people in their network. Trust and relationship are huge. Took a group of 30 of our guarantors and investors to Ghana in January, and we had so many of the guarantors on that trip that came back really excited, and so I capitalized on that. We've had a number of events this year at guarantors' homes. So that's one of our strongest strategies, I would say. So, but happy also to talk offline with anyone that's interested in that. Then maybe one, I know we only have a couple minutes, or you could speak, since you're one of the most recent lenders that put us under due diligence, if you can talk a little bit about what type of underwriting you did on MCE format. That was another question. Are you there, Anair?
Yes. Was that a question to the lenders, to the investors in MCE, or a question?
What type of underwriting is done by lenders to determine if they make a loan to MCE?
Well, yeah. So yeah, we looked at the historical performance and looked at some of the specific diligence memos, and both on the impact side and the financial side, and you know, stress tested thinking through, I think, the dynamics of if particularly the SGB portfolio, which is more, you know, is younger, right, is less mature, and so the microfinance portfolio is pretty seasoned and has been pretty, you know, has been strong and pretty stable over the years. SGB is inherently a riskier portfolio and has a portfolio pretty much by definition, and is less mature. So we looked at that one a little bit more closely in terms of what the actual borrowers were and the actual terms, and then stress tested that one a little bit, and what, you know, or what would it look like if that one accrued losses that were more significant. And you know, with our lender hat on, this is where it's sort of interesting to look at it as both a guarantor and a lender, right? Because as a lender or investor, you take a lot of comfort in, well, but there's this, you know, even if things deteriorate significantly, there is all these guarantees in place, so that's great. But then as a guarantor, you're looking at it from the other side of the coin, so that's interesting. But I mean, I will echo what Sanjay, I mean, which I think is the thoroughness. We were impressed by the thoroughness of the due diligence and that the team's able to do across so many organizations and so many regions. and the transparency, and just really being very, very open with stakeholders and investors.
Great, thank you, Aner. All right, Andrea, I think those are all the questions that I see on this side. I just wanted to turn it over to you.
Yes, thank you. I was also trying to see if there was anything there that we missed. There was one question that came to me on the non-default rate, but I believe you covered it, right? It was a historical 2%, correct?
Yes. Mm-hmm.
Wonderful. Okay, well, and then I imagine the last question would be if people would like to get in touch or learn more. We have here, for those on the line, Catherine's contact. It's covington@mcesocap.org, and we'll be happy to share the deck if Catherine is okay with it when we send out the follow-up email. And in the deck, you will also see this list of resources, including their most recent impact report, notes offering memorandum. It's great that gets shared, the guarantee agreement for the MFI and the guarantee agreement for the small and growing business. So, closing thought, Catherine, or just thanks?
Yeah, no, I just, yeah, appreciation for everyone's time and listening and thoughtful questions. It was a real pleasure. And anytime we get to speak about our model and share it more broadly, we would love for people to replicate or be inspired by it and also challenge us on it. So it's, so really appreciate the opportunity.
Okay, so thank you, and thanks for all the great work that you do. Thank you, Elena, for joining us from Spain to talk a little bit about the portfolio. Thank you, Aner, for joining us from Israel. And thanks to all the participants that came on the call today. If you'd like to learn more about MCE, again, Catherine Covington, you can contact. If you want to learn more about our work with the Investor Network, please reach out to my colleague Kurt at transformfinance.org. Thank you, everyone. Have a good day.